Thank you very much, Adrian, for inviting me along today to present to this group of ladies and gentlemen. My name is Teresa Godwin-Coombs. I am currently an independent financial consultant, having taken the decision 2 years ago to semi-retire at my young age from the EBRD to enjoy a bit of quality of life. But somehow or other, I just can't manage to escape the whole area of sustainable energy investments, and I'm back in that field again. My experience with EBRD was quite multidimensional in that my background is as a financial accountant. I started at EBRD working on donor funds, so trying to align the objectives of the EBRD with the objectives of donors. And after that, I moved into the banking field. So I suddenly became a translator of donor objectives with banking objectives, and understanding bankers' objectives and their language, and working with donors to make sure that we could align both of those interests. And after a number of years, I also became engaged with the energy efficiency financing program of EBRD. And under that, I started having to translate the language of engineers. So now my head is completely full of 3 different types of languages, and I've become quite skilled in ensuring that each of the partners that I'm dealing with understands what the other partners' concerns are. So looking at it from the perspective of bridging the financing gap for retrofit financing, this is the focus of my presentation today. So first of all, the question, why do we need to engage with the commercial banking sector? And I think the answer is quite obvious. They are the key to successfully upscaling retrofit finance. Why is that? Because first of all, they have the funding resources, and they have a business model that requires them to lend. So already we have a ready source of finance. They have existing processes and personnel who are trained to evaluate products, trained to evaluate projects, and to make investment decisions. They have branch networks. Though many of our banks have had to pull back on their staffing, they still have a proximity to the market that any of the public agencies just cannot have. You don't have people on the ground in the small towns, in the cities, whereas the banks do have that proximity and knowledge of the local markets. And finally, they have extensive data for targeted marketing of products. And when I talk about product, I class retrofit financing as a financial product. It's not a technical product. It's a financial product, and that's how the official sales process should be with the commercial banks. This is a good financial product. It's a good investment for commercial banks to make. The data that they have can be targeted very specifically, and we've used, under the EBRD programs, we've used the marketing data held by banks to really target the product, the investment products, at people who are most likely to invest. You know, the banks have information about whose mortgage is coming up to being finally repaid, and is therefore got capital that they can invest. They have an extra €500 a month, which they no longer have to spend on their mortgage, which could be very easily invested into retrofitting the same property that they've been paying for the last 20 years and safeguarding it for the future. So this is something that, you know, the banks have and should be harnessed to progress the energy efficiency mandate. What are the barriers for banking sector involvement in upscaling at a systemic level, financing energy efficiency and retrofit investments? First of all, and this I think was quite a shock for a number of people when I said it before, there is no segment within the banking sector. Building retrofit is not a recognised segment. So there is no data available within commercial banks of what is the performance of their portfolio of building retrofit investments. Any investments that have taken place already are buried within other segments. So they're buried within retail lending, or it could be buried within credit card lending, or they're buried within small business lending or commercial lending. So there's no defined segment within the commercial banking sector. So they can't look back and say these loans outperform other loans. There's a certain amount of, how should we say it, sort of informal knowledge that loans to householders or to small businesses for investment in buildings do perform well. That people who are making these type of investment decisions and borrowing for the purpose of retrofitting their homes, that these people are forward thinking and they're good borrowers. But that is anecdotal evidence at the moment. So from a banking perspective, they don't know how these loans perform. They don't know how these borrowers perform, and therefore they're unproven. And anything that's uncertain in the banking sector is high risk. So that is one significant barrier, is the risk factor. Secondly, we look at capital resources of the banking sector. A lot of the banks had to scale back on their balance sheets and pull back because they don't have the capital resources. But nonetheless, they do have funds to lend. But there is a mismatch between the monies that they have, the funding that they have, and the type of tenors, the length of the loans that need to be made to make energy efficiency, retrofit investments match with the payback periods. So looking at the example from this morning from the UK of financing the insulation of a house, so 9,000 sterling would pay back in about 15 years. So banks don't want to lend for 15 years because they don't have 15-year funding. So then they have this maturity mismatch. So that is another obstacle for banks engaging in this type of lending at a scaled version, at a scaled level. Again, we look at how they operate and their credit decisions. How do they make a decision about whether to make a loan or not? And a lot of it is credit scoring. You know, the computer says no. And with energy efficiency and retrofit investments, the scoring model doesn't take into account future cash flows. It looks at what is the status, the financial status of the individual who's looking for a loan. What is their status now? So because there's no built-in parameter for future cash flows, then the model will say no. So it's a technological issue. And again, we're looking at them financing the borrower rather than the investment, especially when you're looking at small scale projects. If you're looking at a much larger project, like a wind farm, that's project finance, and they're much more skilled at making decisions on those types of investments, looking at payback and IRRs over the length of the program. With individual small projects, like retrofit of an individual building, the borrowers, what they're looking at, and particularly in the current economic climate, there are a lot of people who don't, on paper, make very good borrowers, but their investment in a building retrofit could be a very good investment, both for them and for the bank. So again, we're looking at translation and looking again at the administration of banks. Banks are very heavily IT reliant. They have systems and processes and controls that are implemented at every level of their organization. And they have very busy staff with competing priorities. So it's very hard to convince them to do something that is outside business as usual, that's outside their current processes and practices. So if we were to suggest that they adjust the credit scoring model to take into account, future cash flows from an energy efficiency investment, that's a huge undertaking for a bank. So these are the barriers. And these are the types of things when I was visiting commercial banks across the EU, trying to convince them to engage in the EBRD's sustainable energy financing program. These are the type of concerns that were coming up from the people around the table, that, we can't do this because. So it's addressing that and designing any interventions that you have at a policy level or strategy level to, first of all, understand what the concerns of the banks are, and then to eliminate them. So coming to the solutions, so what is needed to overcome the banking sector's inertia and get them moving? Sorry, I think I've skipped a slide. sector level commitment. So what we found is that by talking to one individual bank, you can get individual commitment, and that's fine. But unless you try to involve the whole top tier of the banking sector, commercial banking sector in a country, you don't motivate enough involvement. So getting policymakers to consider some sort of mandatory requirements, especially at the moment when we have a number of our banks in Europe that have government control or heavy government ownership, having had to bail out the banks. This is a good time for policymakers to consider implementing mandatory requirements for banks to dedicate a percentage or proportion of their new lending to energy efficiency, to building retrofit. Talking to the sector using financial language is very effective. Selling building retrofit as a finance product rather than a technical product. It's not for the good of the planet, it's for the good of the bank. Looking at alleviating the funding constraint, as I said, capital is there, but there is this maturity mismatch. So trying to provide from official sources or EU sources ring-fenced funding. So not general capital funding for the banks, but ring-fenced money that you say, here's 100 million on an attractive term, whether it's giving them a tenor that's longer than they can get from the capital markets or at a slightly reduced interest rate. But this money can only be used by you to invest in energy efficiency projects. So alleviating the funding constraint in that way. And looking at what the EU calls innovative financial instruments. So not just straight lending, not just bank lending, but also looking at other products, risk participation in projects, or providing a risk cushion for the bank's portfolio in this area. So it takes away some of their concerns about risk. Looking at other products, like leasing, for example. There's a number of retrofit investments that could potentially be good leasing assets. Another aspect was keeping it very, very simple. Providing the technical expertise for banks to implement lending programs. And when I talk about technical expertise, I don't really just talk about engineers. I talk about marketing experts, financial experts, helping the banks to look at who their current borrowers are and how they can get people through the door to borrow money for retrofit investments. And removing detailed criteria. So no references to EU directives in any correspondence between the policymakers trying to involve the banks and the banks themselves. So my lessons learned, and this is from many years on the road and sitting in many boardrooms and conference rooms, is involve not just the senior management, who will very quickly give you a nod of appreciation and thank you very much and we're very concerned about this whole area, but also the middle management, because these are the people that have to actually implement a program once their bosses sign up to something. Understanding the internal structures and the conflicts within a bank will help you to speak the right language, knowing that the credit division within a bank will have a lot of sway over how the bank can fund itself. So if credit will say no, then there's no point in the bank accepting funding for retrofit financing. Set realistic goals for expected lending volumes. So if you're going to visit a commercial bank and you're going to say, well, we want you to do 100 million euro in retrofit investments over the next 5 years, if that's representing 50% of their lending volume, then that's never going to happen. So understanding from just a quick look through the bank's annual report, you'll have an understanding of what their new lending volumes are. So you're speaking a language that is realistic. Focusing on technical assistance support, and I can't underemphasize this. The programs that we had with the EBRD were very well supported through technical assistance. And these programs were designed to be multidisciplinary, with marketing support, with engineering support, with project management support, so constantly pushing the banks, understanding where they are with pipeline development, bringing new projects to the banks so that they can see concrete projects happening, and therefore understanding that it's worthwhile investing resources, human and capital resources, in investing in sustainable energy, and providing meaningful case studies. So nice, colourful pictures of the house around the corner that has been insulated, and those householders are currently enjoying not only a warmer home but also cost savings. This helps to make a concrete connection for bankers between what you're trying to sell them and what they can actually do behind the counter in their bank branches. And it's quite controversial from years of having to fight with economists about allowing us to give grants. But when you're talking to bankers, the idea that an investment requires a grant to make it viable just confuses the whole matter. So if there are grants, that's nice, but don't focus on them. Am I jumping again? So converting talking to action, so aids for banking sector involvement and implementation of any of the programs that you might design as part of the implementation of your energy efficiency strategies, is don't try to interfere with what the banks do best. Don't try to impose pricing or try to impose credit criteria on the banks. They will reject it. And allowing them to do business as usual is very important for longer term integration of retrofit financing as a product, as a financing product. Support the banks to market to their existing clients and maximize attraction of new desirable clients using simple case studies and marketing support. It's a sales effort that you're asking the banks to undertake. It's a sales effort more than anything else. Coordinating policy dialogue to eliminate any obvious ongoing barriers, and having public information and education as an ongoing and parallel initiative. And again, I'll come back to technical assistance. Identifying early investments that are ready for bank financing gives the banks confidence, and Tatiana mentioned trust. Once they have a small portfolio of investments that are performing well, they have borrowers coming to their counters and asking for these types of loans, and they're paying back their loans, then you have a good starting point. Publicising early wins, involving high-level politicians, involving the CEOs of banks, and reducing as far as possible their administrative burden. I've just been told to be quiet, so I think I could talk forever on the subject. So thank you very much.